Hi everyone, my name is Hyashinta Tampubolon, majoring in accounting from University of Sumatera Utara. As we know, there are so many types of companies. One of them is partnership, especially partnership firm. For example, an accounting firm. So, this time, I'm gonna explain to you all how the forming of partnership and accounting for formation of it. There are two important things that we will learn. First, nature of partnership entity. We will know the definition and characteristics of a partnership. Second, accounting for the formation of partnership. We will know there are three types of recording a partnership's book. Definition of a partnership. A partnership is the association of two or more persons, usually individuals or maybe corporations, that carry on as CEO owner of business for profit. Partnership formation requires an agreement. The agreement can be as formal, like many page of agreement, or as informal, like handshake. There are 5 characteristics of a partnership. 1. Limited life. The life of a partnership may be established as a certain number of years. If no such agreement is made, the death, inability to carry out specific liabilities, bankruptcy automatically terminates the partnership. 2. Mutual agency. In a partnership, the partners are agents for the partnership. One partner may legally bind the partnership to a contract with inline the partnership's operation. 3. Unlimited liability. Partners may use their personal assets or capital to satisfy partnership. 4. Ownership of an interest in the partnership. The only transferable interest of a partner is his or her share of profits and losses of the partnership and the right to receive distribution, including any liquidating distribution. 5. Participation in partnership profit. When forming a partnership, there will be an agreement that dictates the profits and losses are shared. Absent an agreement, the partners will share the profit and losses equally. Accounting for the formation of a partnership. Like what I said before, there are 3 types of recording a partnership's book. First, a partnership formed by the association of 2 or more individuals. The individual is someone who has not or does not have a company. Individual can invest or contribute cash or non-cash when forming a partnership. For example, a partnership is started by Noah and Peter. As an initial investment, Noah invests $10,000 cash and Peter invests $20,000 cash. The entry to record the investment in partnership is debit on cash $30,000, credit on Noah capital $20,000, credit on Peter capital $10,000. Another example, Nikki, Brian, and Joji agreed to form a partnership. As initial capital, Nikki contributes $20,000 cash. Brian contributes equipment worth $40,000. Joji contributes inventory worth $30,000. The journal entry to record the initial capital contribution on the partnership's book is debit on cash $90,000, credit on Nikki capital $20,000, credit on Brian capital $40,000, credit on Joji capital $30,000. Second, a partnership formed by the association of individuals and corporations or proprietorship. In this type, there are 2 methods of recording a partnership's book, such as the corporation's book continue as the partnership's book, and the corporation's book close or not continue as the partnership's book. For example, Ash and Golden Corporation agreed to form a partnership named Golden Ash Partnership. In slide, we can see the balance sheet of Golden Corporation. There are total assets and total liabilities and equities $60,000. Golden's business is audited. The audit disclosed that the equipment has a fair value of $32,000. Ash contributes $10,000 in cash. The Golden Ash Partnership is to acquire all of Golden's business and assume its debts. To fulfill an investment of $47,000, Golden will contribute cash. The entry to record the initial capital contribution on the partnership's book are: first, based on Golden Corporation's book. In investment of Golden Corporation, we can see the equipment has a fair value of $32,000 from $35,000. So, the difference is $3,000. The journal entry is equipment $3,000 in debit, Golden Capital $3,000 in credit. To fulfill an investment of $47,000, Golden contributes $5,000. Why $5,000 cash? We can see in balance sheet of Golden Corporation capital $45,000, and the fair value has a difference $3,000. So $45,000 means $3,000 is $42,000. So $42,000 to fulfill an investment of $47,000, we need $5,000 cash. So Golden contributes $5,000 cash. The journal entry is cash $5,000 in debit and Golden Capital $5,000 in credit. In investment of Ash, the journal entry to record investment of Ash is cash $10,000 in debit and Ash Capital $10,000 in credit. Second, the corporation's book close or not continue as a partnership's book. In investment of Ash, the journal entry is cash $10,000 in debit, Ash Capital $10,000 in credit. In investment of Golden Corporation, we can see the difference from the previous type. Then, we can see the balance sheet of Golden Ash Partnership. Third, a partnership formed by the association of two or more corporations or proprietorship. For example, Alt and Young have sole proprietorship. They agreed to form a partnership named Alt-Young Partnership. First, Alt Corporation's book continue as the partnership's book. In investment of Alt, we can see the equipment has a fair value of $9,000 from $7,000. So, we can see the increase of $2,000. In investment of Young, we can see the journal of all of the accounts. Second, the corporation's book close or not continue as the partnership's book. In investment of Alt, we can see the entries of all of the accounts. In investment of Young, we can see the entry is same as before. After that, we know about the balance sheet of Alt-Young Partnership. We can see in slide total assets and total liabilities and equities of Alt-Young Partnership are $40,000. Well, that's all my explanation. There's still probably a lot of questions arise. So, if you have questions, you can put it in the comments column. Thank you for listening. Goodbye.